All right, let's dive in. Today, we are going to crack the code on one of the most powerful and maybe one of the most misunderstood tools in all of finance, the candlestick chart. Let's get to it.
So, have you ever looked at a chart like this and just your eyes glaze over? It's like trying to read a completely foreign language, right? Just this big, messy wall of red and green lines. Honestly, it can look super complicated, maybe even a little intimidating.
But here's the thing. Don't worry. Because just like any language, this one has its own grammar, and believe it or not, it's pretty simple. By the time we're done here, you're not just going to see a bunch of bars. Nope. You'll actually be able to read the story that every single one of these candles is telling. Okay, so first things first, we're going to break down just one single candlestick. Because really, if you can understand one of these, you can understand all of them. These are the building blocks. It's actually pretty incredible how much information is crammed into this one simple shape. See, each candle tells the story of a specific chunk of time. Could be 1 minute, could be a whole day, even a month. And it's really just made of two parts. You've got that thick part in the middle, that's called the body, and then you have those thin lines sticking out, which we call wicks or shadows.
So, how is one of these made? Well, every single candle, no matter what it looks like, is built from just 4 pieces of information. 4 key prices. You've got the open, which is, the very first price in that time period. The high, that's the absolute peak price it hit. The low, the absolute bottom it touched. And finally, the close, the last price right when the time was up. That's it. Those 4 points tell you everything.
So what's with the colors? Why are some green and some red? It's actually super simple. If the price closes higher than where it started, the candle is bullish. Think green for go. It means the buyers were in control. But if the price closes lower than it opened, it's bearish. Think red for stop. That tells you the sellers dominated that session. So right away, the color just tells you if the price went up or down. Easy.
Okay, let's think of this as a story, or better yet, a battle. The trading period opens, and ding ding, the fight begins. Buyers and sellers start pushing the price around. They push it all the way up to a high point and all the way down to a low point, and that's what creates those wicks. Then, finally, the bell rings. Time's up, and the price closes. The space between where it opened and where it closed, that's the body. And boom, the candlestick is formed, a perfect snapshot of that battle. All right, so we've got the basic anatomy down. Now it's time to actually learn the language, because the shape and the size of these candles, they tell a story that's way more interesting than just the numbers.
This right here, this is probably the most important idea to remember. The body shows who won the battle. The wicks show where the fighting happened. It's that simple. The body's all about power. It tells you if the bulls or the bears won and just how big their victory was. The wicks, though, they show the struggle. They're the high and low ground that was fought over but couldn't be held by the end. And this is where it gets really interesting. The size of the body tells you so much. If you see a long body, that was a blowout, a decisive win. It means there was a ton of momentum in one direction. But what about a short, little, stubby body? Well, that's a stalemate, a nail-biter. It signals total indecision in the market, where buyers and sellers basically fought to a draw.
The wicks are just as important. They tell the story of what happened at the extremes. So a long upper wick, that tells you the buyers tried to push the price way up, but then the sellers came in and just slammed it back down. That's what we call selling pressure. And on the flip side, a long lower wick means the sellers tried to tank the price, but the buyers weren't having it. They rushed in and propped it up. That shows you there's strong buying support. Now for a really special one. What happens when that battle we talked about ends in a perfect, dead-even tie? Well, you get this, a doji. It's a candle where the open and close prices are basically the same, so the body is just a thin little line, kind of like a cross. This is a huge signal of pure indecision. It means the market is perfectly balanced on a knife's edge, at a crossroads, and nobody knows what's coming next. So, we've got our alphabet, we've got some vocabulary, now it's time to put it all together and start reading whole sentences, to start reading the market story. Okay, so if you're going to remember anything, remember this. It's a simple 3-step check for any candle you see. Number 1, the body. That shows you the power of the move. Number 2, the wicks. They show you the pressure points. And number 3, the color. That just shows you the direction, up or down. That's really the whole shebang right there. What we've done today is learn the alphabet. It's the absolute foundation of reading these charts. Each one of those candles is like a single letter.
And as you can see, experienced traders learn to combine these letters into words and even full sentences. These are called patterns, and they help predict what might happen next. But it all, and I mean all of it, starts with understanding just one candle.
So, the next time you pull up a stock chart, I hope you don't see a foreign language anymore. I hope you see what's really there. A story about buyers and sellers, about pressure and momentum, unfolding in real time. The only question is, are you ready to listen to what the market has to say?